Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
But we have these spikes of high volatility in all these classes, and when we see these ebb and flows of risk aversion and appetite come back and forth when the Fed speaks. Every time Geithner speaks, we see a spike in dollar volatility, usually against our positions, it seems. We even have a new name for it. We refer to it as being Geithnered here. John Ross and I, said, oh, we're being Geithnered again. So we're seeing high volatility even in some of these asset classes that are going up, and that goes to the point that we're really not sure what the shakeout's going to be in the global economy. Are green shoots for real? Or are we going to fall back into this morass? So that's creating, it's just not good material for the carry trade, even though I think we're seeing some of it because U.S. rates are so low. As we said, in general, when yields start to normalize, meaning the spread goes down, and now we're in the process of the rush to ZIRP, zero interest rate policy, from all the major economies, as these yields normalize and come closer and closer together, it really changes the game on the carry trade. One of the reasons you want to, when you think of the carry trade, you want to think of the major currencies in the world because, the Bank of Japan, European Central Bank, U.S. I mean, there's the depth in the market borrowing the major currencies, and that's why they tend to be the carry trade currencies. Even though you may have a very, very low yield in some of the emerging market currencies, it's tough to borrow those just because of the fact you don't have the liquidity. So when we talk about yields normalizing in this sense, we're talking about the major currencies. So we see fewer opportunities as the yields normalize and get closer and closer together in the spread, and there's not much spread differential, and we think that's happening, which is tamping down on the carry trade. A change in the global credit cycle, we think this is going to be a change for years. Sentiment and the regulatory change are pressing down. The regulatory change is huge. I don't think we're going to see really just the same ability to do this type of thing, even if we wanted to. And obviously the sentiment is changing not only on the institutional side of a lot of players that got burnt taking on too much leverage in this what looked like a layup trade. We're seeing the sentiment change in a very, very big way in retail investors that are starting to save. And if they start to save, again, that presses down on the global credit cycle. We think growth is going to really just muddle through at best on the major economies in the world. And if that's the case, you're not going to see the asset classes, the risky asset classes in general, zoom straight up like we did before. Ultimately, if the industrialized world is muddling through and just growing subpar, way below capacity, you're not going to have that same environment of very, very high growth and anticipated strength in the asset classes in which you would borrow low-yielding currencies to invest in. So all these things we think are going to press down and really are changing the game on the carry trade in a big way. So that's, kind of, I think I just explained that, the upshot of this normalization on currencies, and you're not seeing the correlated asset movement, the momentum we saw in the past, these giant liquidity-driven cycles with the U.S. dollars going down, and these ability to fund all these asset classes, is there consistently. One of the things in play right now, and I talked about the BRIC countries, there's still this idea coming back into play of decoupling, meaning the belief is that China, Brazil, India, and Russia can carry global demand, and some people are cheerleading for this in a big way, and that's why we're seeing this. And as I said, they have to carry global demand for this decoupling theme that's coming back in play because emerging market stocks and emerging market countries are starting to do well again. This is it. it's still, we think, global growth. Global growth from the major countries is ultimately the driver, and we're not sure this abundant liquidity is going to be there. But this game is playing out right now, and it's playing out in the right way, and that's why we've seen a huge move in the Australian dollar. And if we're very, very wrong here, and this decoupling does take place, and these countries can carry global demand, meaning primarily China keeps the music playing, the commodities will continue to go up. We will start to see inflation and a turn in prices that we haven't seen, and that in and of itself may create some opportunities and wider yield spreads in the future, as opposed to our view that we see deflation as the problem and a continued normalization. This would suggest the spreads start to widen again between some of the higher yielding currencies and the lower ones. And again, this whole environment right here creates the opportunity for the carry trade to come back in play. And as I said, it's playing out right now in the emerging market world. So if we're wrong on this decoupling right here, and they can carry global demand, then the play is to continue to pour into these currencies, and of the emerging market currency, the major currencies that are listed on the ISE to play using FX options, it would be the Australian dollar and the Canadian dollar. The commodity currencies would be the best ones to play if the carry trade and this risk is back in play. Again, to show you an example here, U.S. dollar yielding 0.32%. Australian dollar yielding 0.325%, Brazilian dollar yielding 10.16%. Shows emerging market stocks, Brazilian real, Australian dollar, all moving up in the same bucket here. A very, very powerful move on this idea that decoupling is back in play. So if it is, and we're wrong, then the trades are definitely continue long Aussie. The Aussie right now is at 80 cents. If you remember, in the midst of the cycle, the Aussie got to around 98 cents against the U.S. dollar. Steve will show this the other way, actually. But the Australian dollar almost went to par. If this is in play, it looks like the Australian dollar could go back to par, and it would be a great trade, playing the Australian dollar to go higher using the FX options. And Steve will show you hopefully some examples there. Now let's get to the Japanese yen. This is very interesting what happened in the Japanese yen. Both times we've seen a major carry trade in place. 2007 wasn't the first time we saw the carry trade. We actually saw it in 1998. If you remember, what changed the game in 1997, 1998 was the global financial crisis, the Asian financial crisis. At the time, we saw the same thing happening. The Japanese yen, this is Japanese yen against U.S. dollar, so we saw the Japanese yen falling in value against the U.S. dollar and the other major currencies as the hedge funds were borrowing Japanese yen and investing in all those tiger countries, Malaysia, Thailand, Singapore, and everything was going straight up. So they had a very, very big bet back then, 138 billion at the time. Behind the yen carry trade, they leveraged up. And then sure enough, the Asian financial crisis hit. We saw AF hit right around here when people got wind of it. And we had the contagion that contaminated all those tiger markets. And what happened? The hedge funds had to come in and pay back all these loans. When you borrow in Japanese yen and then Japanese yen starts the other way and the other asset classes you invested in, remember, stop going up and start going the other way, then you have to reverse this trade and get out of this position. And how do you do that? Well, you borrowed yen initially to get in the position. So number one, you borrowed yen. Number two, you converted it and reinvested it into some other assets. So you just reverse that trade. So all of a sudden you start selling the other assets, whether that's emerging market stocks in all those Asian countries or emerging market bonds in those Asian tiger countries. You sell those, then you convert the dollars into Japanese yen, because you then have, so therefore you're buying Japanese yen so you can pay back those yen loans. So as you're buying Japanese yen to pay back those yen loans, you get this rocket move in the Japanese yen as the carry trade is closed. 46% move we had the last time on this, the Asian financial crisis.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.